Hello, and welcome to the Virtual Investor Conferences. My name is Athena Katsulis. On behalf of Social Suite, as well as the OTC Markets, we're very pleased to have you join us for our next live presentation from WallBridge Mining Company, Ltd., a company focused on the exploration and development of gold projects. Please note you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Scheduled Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Mars Cord, President, CEO, and Director of WallBridge Mining Company, which trades on the OTCQX Best Market under the symbol WLBMF and on the TSX under the symbol WM. Welcome, Mars.
Thanks, Athena. And I want to thank everybody for joining us here to listen to our story, and thank OTC to provide the platform for us to be able to tell the story. I will be making some forward-looking statements, so I encourage you to read that on our website in our presentations. Perhaps maybe we can talk about the investment criteria, especially in the exploration and junior mineral sector. Some criteria really needs to be looked at before you invest, and one of them happens to be the jurisdiction. We're fortunate that WallBridge has its properties in Quebec, Canada. Quebec is one of the most sought after locations in terms of mining investment, partly because there is respect for the rule of law and property rights, great infrastructure, and supportive communities and supportive First Nation partners. More importantly, you want to invest in a property package that already has shown or has demonstrated potential for growth and metal endowment. We're also fortunate that our properties are in the Abitibi Greenstone belt. This is one of the most prolific belts globally in terms of metal endowment, particularly gold. As we can see in Abitibi, we have the Timmins Camp, the Crook Lake Camp, Rouen to Val d'Or, and more importantly, the package of properties that we currently own in the northern Abitibi, which today has demonstrated a large gold system at Detour Lake Mine, which is owned by Agnico. That's one of Canada's largest gold mines. And along the same belt, we have a large prospective land package, and we've also demonstrated two large gold systems, one at Fenelon Gold Project and one at Martiniere. One important part of this whole thing is that we have a large district scale land package, and that's also a criteria in terms of growth potential. Today, we've only scratched the surface of this underexplored land package with the two properties at Fenelon and Martiniere, but we own and control about 97 kilometers of land right from the Ontario border where the Detour Lake Mine is to the east, over 830 square kilometers of land package. And we have one of our most advanced projects, which is Fenelon, which currently not only has the mineral resource estimate, we just published about a month ago a preliminary economic assessment on that deposit, a very positive preliminary economic assessment, which really is just a starting point for the development and expansion of that project, in addition to Martiniere, which is 30 kilometers away from it, that could potentially be once we find the size potential of that, be able to add that to the economics of Fenelon. Now, the other criteria is really management track record. Track record for us is what we've done recently. We purchased this small land package in late 2016. Successful exploration allowed our currency to be valued, to be able to also acquire Balmoral resources, which we originally purchased that very small property. Balmoral owned this entire land package. We made a major discovery in 2019 in the Area 51 and Tabasco Cayenne zones, which is really the subject of the mineral resource estimate at Fenelon and also the preliminary economic assessment. At the same time, Balmoral already owned a very prospective nickel deposit of about 5.5 million tons of close to about 1.6% nickel equivalent, as well as WallBridge's Sudbury package of properties, which was a large package of properties. We decided to really focus on our gold exploration along this Detour-Fenelon gold trend, and we divested our nickel assets to a company called Archer Exploration. We were about an 85% shareholder of Archer. We returned most of that capital back to our shareholders in November of last year, and we still currently own about 19.9% of Archer, along with the 2% royalty on the Grasset property. As I mentioned, we updated our mineral resource estimate at Fenelon and Martiniere in January of this year, and we advanced the Fenelon deposit to a preliminary economic assessment, which is looking at a large underground bulk mineable deposit of about 7,000 ton a day, with a $721 million NPV, and also about 212,000 ounces of gold production annually over a 12.3 years mine life. So it's a very positive economic assessment, but more importantly, it really is scratching the surface of that deposit, and I'll explain that a bit more in detail. We've done all of this with firm ESG principles in mind. You know, we've always continued to work on the ESG principles. You know, social responsibilities, health and safety. We've got a great track record in terms of health and safety. What we're most proud of is our relationship that we have built with the First Nation communities. Today, over 25% of our workforce is made up of the Indigenous members of the communities around, and we also signed a pre-development agreement with the Cree communities in August of last year, which really provides the support for the advancement of our projects along this large land package of the Detour-Fenelon gold trend. Before I go into the technical details a bit into the Fenelon and Martiniere, maybe perhaps give you a bit of a understanding of our share structure. Today, Agnico Eagle currently owns about 9.9% of our of company shares. Eric Sprott's about 17.5%. William Day, who really was one of the supporters of the company prior to the purchase of Fenelon, currently still owns about 6% of the company, and the balance is in the retail and institutions. In terms of cash, as at the end of March, we had about $30 million in cash. At the end of June, roughly about $20 million in cash. We have a very large program this year of about $36 million. So by the end of the year, we'll be left with about $2 to $4 million of our own cash. But more importantly, because we're in Quebec, for every dollar that you spend, you receive about 38.5 cents of refundable tax credit from the government of Quebec for economic development that you've created. So as a result, last year we had submitted the 2021 refundable tax credit, and we received about $21 million. This year we submitted our 2022 tax for the tax credit, and we are expected to receive about $13.5 million before the end of this year. We're hoping actually it'll be at the end of the third quarter. So with that, we are fully funded for this year's program. We're gonna end at the end of the year with roughly about $14 to $16 million Canadian. So that gives us the flexibility in order to be able to design a program to advance our projects without being too dilutive to our shareholders. So let's dive into a bit of a technical on the deposits. Let's start with our most advanced, which is Fenelon. Today it has about 2.37 million ounces in the indicated category and about 1.7 million ounces in the inferred category. And we together between the Fenelon and Martiniere is roughly about 3 million ounces of indicated and about 2.35 million ounces of inferred. So roughly about 5.4 million ounces between the two deposits. We still believe that Martiniere, as our second most advanced project, still requires about a couple of years before it gets to Fenelon's sort of stage. And we believe Martiniere would be our next multi-million ounce deposit, obviously after some exploration drilling that we can do. Fenelon itself was advanced to a preliminary economic assessment. Really, the preliminary economic assessment really was down to about 1,000 meters. You can see in this middle figure, roughly, the purple area. We drilled a hole down to 1,500 meters just to demonstrate to ourselves and to the market that this property or this deposit doesn't stop at 1,000 meters. At 1,500 meters, we still got the same geology, same gold mineralization, and about 4 meters of 17 grams a ton. So we certainly see the growth potential to depth. But as you've seen with a lot of the exploration results that we've so far identified this year, that there is actually a lot of lateral growth potential at Fenelon. We drilled at roughly about 1 kilometer to the northwest of the deposit, and we see, we intersected very similar gold mineralization right at surface. We went 2.5 kilometers to the southeast of the property, and we managed to get the same kind of a gold mineralization with some visible gold and some good results. So we certainly see a lot of lateral expansion potential at Fenelon, that there really isn't a need today for us to spend the valuable dollars to expand the resource to depth, but we certainly see that has the potential to grow. So the preliminary economic assessment really was done based on this current confined area of roughly about a kilometer by 600 meters down to about 1,000-meter depth, and we see this as a very good starting point in terms of the economics of the project. So the project was looking at a high tonnage bulk mineable scenario, and we see that over a 12.3 year mine life, we're able to generate about 212,000 ounces of gold annually, with an annual free cash flow after tax of about $157 million, and the NPV after tax of about 721. What's important about this project, and I compare that to some of the current operations, it's the all-in sustaining costs that are about $924 US per ounce. And the capital requirement, the initial capital, including some of the pre-production costs, are roughly about $645 million. So the way we approach this PEA, unlike some of the PEAs that we see in the market these days, is that it actually had a bit more engineering done to it in order for us to be able to really come up with a more respectable economic study. And more importantly, we also realized that over the past 2 to 3 years, there's been a cost escalation in a lot of projects. So as a result, all of the cost estimates that we have done is based on the current costs, as well as contractor supplied bids to the or proposals to the project, as well as the equipment suppliers' prices. And at the end of the day, we also reviewed the costs that we had done based on the first principles against the current operations that are similar to Fenelon, to make sure that there is also another confidence level in those numbers. So we're pretty comfortable with the numbers that we've provided. The way the project was reviewed, that because the project starts right at surface, there is already an existing infrastructure, a ramp, a large 5.7 by 5.5 meter ramp that already goes down to about 180 meter elevation. So we can use the existing ramp, extend that, and in the first few years of the production, we can actually use the ramp for transportation of material to surface. And then starting the second year of the full production, we'll do the shaft construction down to about 1,000 meters. And starting year 5, all of the material will be transported through the shaft. This is basically the way we did it. Is we wanted to be the most capital efficient in terms of the project advancement. And you can see in here that the annual gold production ranges roughly about, mostly above 200,000 ounces, but the average is about 212,000 ounces. The grade is anywhere between 2.7 to above 3 grams a ton. Again, a lot of people may look at an underground deposit. Why, at 3 grams, is it profitable? But we also have some comparables to the Fenelon that are currently successfully operating, but by major companies. So in terms of infrastructure, it's a pretty compact area. It is an underground, not an open pit, so therefore the footprint is quite compact, allows us to be able to expedite the permitting process in here. We currently at the camp, we have a 160-person camp that is expected to be expanded in the construction to be about a 340-person camp. During the construction, we also have some temporary facilities that we've added. In terms of the mine site, it's sort of a modular tailings facility, starting with phase 1 and 2 and 3, depending on the stage of the production, and obviously the shaft and the head frame, you can see it in the center of the site. So it's quite compact. And in terms of tailings, I'll explain later that we actually have, allowed in terms of metallurgy to be able to desulfurize our tails. So therefore, the tailings facility will have a clean tails, which again allows you to expedite the permitting process. And the sulfide tails will be sent underground as paste backfill. Overall recovery is quite significant. In fact, we have up to 66.5% of our gold in the Tabasco and Cayenne is recovered through gravity, and about 84% of that is recovered from Area 51 in gravity. So the overall gold recovery is roughly about between 96 to 97%. The preliminary economic assessment has used a 96% overall gold recovery. And it's a pretty simple flow sheet of gravity, carbon and leach, elution, gold room, and then obviously, as I mentioned, we detox the residue by doing the flotation and sending the tails with the sulfides as paste fill underground. So all of these will help in terms of expediting your permitting, if you may. And here we have a detail of the initial capital expenditures. The mill is a 7,000 ton a day mill, roughly about $220 million, and then paste plant, as well as the surface and underground infrastructure. And in terms of the sustaining capital, obviously the shaft, as I mentioned, will come into when we have we're in full production of about 7,000 ton a day, and to maintain that 7,000 ton a day, we're able to use the shaft as a sustaining capital. The overall cash cost for us is roughly about $750 US per ounce, and the all-in sustaining cost, as I mentioned, is about $924 US. So this is basically the free cash flow annually. The first 2 years of pre-production is roughly about $645 million, and then we start generating positive cash flow going forward to the end of the project. We did some sensitivity analysis in order to make sure that we demonstrate to ourselves and to the market that the project is quite robust. Obviously, if you use current spot prices and the Canadian to the US exchange factor, the project is got about a after-tax NPV of over $1 billion. And when you really look at it, the project is quite sensitive to gold price. But the second most sensitive component would be the operating cost because of the production profile of 7,000 ton a day. But even with that, anywhere between 10 to 20%, you still see a pretty respectable net present value for the project. I did mention that I wanted to compare this Fenelon PEA to a few of the current operating successful operations. So the most analog project to Fenelon would be the Young-Davidson of Alamos. Young-Davidson today is mining anywhere between 2.2 to 2.3 grams per ton, and they have an all-in sustaining cost of about $1,100. Goldex of Agnico is currently mining roughly about 1.7 grams a ton, and their all-in sustaining cost is under $1,000 US per ounce. But what's important about it is that in terms of production profile, you can see Fenelon today at 212 compared to those is higher, partly because of the grade of the deposit, because when you look at the resource of the Goldex or resource of the Young-Davidson, Fenelon's resource was a higher grade. More importantly, in terms of production profile and the costs, Fenelon certainly is in Quebec. Quebec's energy costs are close to about almost 1/3 of what it is in Ontario, where Young-Davidson, for example, is operating. So higher grade, better energy costs, and the deposit type certainly allows Fenelon to be producing over 200,000 ounces over 12.3 years, and with an all-in sustaining cost of under $1,000 US. So quite robust, and this is really, as I mentioned, is really a great starting point for us, as you could see that Fenelon deposits only constrained by the amount of drilling, and is not constrained by geology. So there's a lot of growth potential laterally and to depth. In terms of permitting, having been a consultant for many years in this industry prior to being in WallBridge, and typically in Quebec, the project can be permitted between 18 months to 2 years. This project is above 5,000 ton a day, so it also triggers a federal process, which could add about another year to it. So you're looking at a 2 to 3 year permitting process. And in terms of our First Nation engagement and First Nation consultation, as I mentioned, the great relationship that we've built with our First Nation partners has allowed us to be able to engage with them on a continuous basis. In fact, we have weekly meetings with the First Nation communities talking about our economic development, job opportunities, contracting opportunities that they may be able to assist us. And also one of the things we believe on local sourcing and local expenditures. So Martiniere is only 30 kilometers away. I live in Sudbury. Most of the mines are about anywhere between 50 to 70 kilometers from a processing facility. So we see Martiniere sort of being another satellite deposit or another deposit that can be processed at the hub, which would be Fenelon. So today we're doing our exploration at Martiniere, trying to really find the size potential of that deposit. We believe it's our next multi-million ounce deposit. It's really only been drilled down to about 400 meters. And it's, as you can see from some of the recent releases that we've had, that Martiniere has the potential to grow not only to depth, but laterally. And some of the results that we identified, particularly when it comes to the extensions of the Bug Lake and the Martiniere West, you can see there's a lot of potential for us to be able to achieve that multi-million ounce stage for Martiniere. So this year's program is about a 50,000 meter program. Half of that was dedicated for Martiniere to find the size potential. The other half was really looking at the regional exploration, finding other satellite deposits or potentially a new discovery. And we continue to do the studies at Fenelon as well as at Martiniere. Fenelon, 4 years ago, we started our environmental assessments and all of the engineering and environmental studies that are required, and we'll continue to do that this year and in the following years. So, in a nutshell, when you really look at the investment criteria, we believe that we tick some of the most important elements in terms of your investment criteria. Today, most of them are, junior exploration is undervalued, and we believe we're one of them. But when you do your due diligence, and I encourage everybody to do their due diligence, to really look at, if any of those undervalued companies currently check those criteria, and more importantly, which one has the more upside. And we believe that today WallBridge is based on what we currently have in terms of resources in the inventory and the growth potential, certainly is undervalued. But again, you've got to do your due diligence in order to do that. So I've now opened that to questions. I see. It says, what is the flow sheet and where would the ore be processed? So we expect to build the 7,000 ton a day processing facility right at site, and that's where the material will be processed. It says that the 594 million sustaining capital brings total capex to 1.2 billion. What is the shaft size and depth? What is the status of rock mechanics at depth? So good questions. Let me talk about the shaft. So the shaft is about, I believe, is about $140 million altogether. People look at that and they say, well, is that estimated correctly? And actually it is, because it's actually been supplied by the mining contractor's bid. The shaft is only a production shaft. It's essentially just the two 18-ton skips that will be equipped in this shaft. And in fact, the most recent shaft that is being currently constructed is Alamos is currently doing the Island Gold, and I believe that shaft is a fully equipped shaft, not just a production shaft, down to 1,500 meters, and the current budget is about $180 million. So we certainly see our shaft of I believe 5.2 meter diameter shaft, strictly for skipping, is correct, and the depth is about 1,040 meters. In terms of rock mechanics, there's been a lot of geotechnical work that's been done, sizing the stope, and all of those can be seen in the technical report that will be issued prior to the 45-day since June 27. So I believe it would be somewhere around between August 7 and August 10. And you can really see the detail of the rock mechanics, sizing the stopes, and the ground is quite competent. These are in typically area 51 is in the diorite, and our Tabasco Cayenne zones are in the sediments that are quite have a quite high RQD and quite strong rocks. Let me see if there's any other questions in here. What was the rationale for divesting your nickel assets and expectation for Grasset royalties? So first of all, we wanted to focus on gold exploration, and we founded Duluth Metals. We had our Minnesota properties in 2006 that we spun out into Duluth Metals. Duluth went on its own, and in fact, Duluth reached as much as $4, and we had given for every 4 WallBridge share, 1 share of Duluth. Essentially, we gave $1 dividend to our shareholders. The reason we spun this out is because it wasn't our focus, and we certainly wanted to see if we can actually give value to our shareholders. Obviously, Archer Exploration, currently is still doing some exploration and trying to demonstrate the size potential of the Grasset deposit. But we certainly see a lot of value in holding the Archer shares, and I encourage the ones that receive those return of capital to do the same, because we certainly see there's a lot of great potential for Archer to not only come up with a great additional deposit at Grasset, but also their Sudbury assets. So that was really the rationale for divesting. In terms of royalties at Grasset, we maintain a 2% royalty, and we are going to keep that because we believe that royalty will be actually a quite valuable asset for the company in the future. What are your key milestones for the next 12 months? Well, certainly the 50,000 meter drilling that we've programmed for this year continues to provide us with good results. We have about 8 exploration targets at Fenelon, 8 at Martiniere, and a few others along this large underexplored land package. We're hoping that this year we'll be able to get to the size potential of Martiniere, but it may very well be that we have to do additional drilling in order to really get that. And that's what we did, by the way, at Fenelon. In 2020, we decided that it's best for us to really get the size potential of Fenelon prior to drilling in between. So today, all of our exploration drilling at Martiniere and at Fenelon are 200 to 300 meter step outs in order to really get that size potential rather than trying to incrementally add to the resources. What is the distance between Martiniere and Fenelon? Could Martiniere West or Bug Lake be seen as an underground mine eventually? So the distance between Fenelon to Martiniere is about 30 kilometers. There really is already some trails and everything else. It doesn't take much to put a road. There would be one large river crossing that would require a bridge. So we certainly see that as a great opportunity to add to the Fenelon's production profile, either lengthening it or increasing it in the future once Martiniere demonstrates itself to be a multi-million ounce deposit. And we see Martiniere's sort of grade profile very similar to Fenelon. Potentially Martiniere will have an open pit component, but perhaps more in an underground, because as I mentioned, it's only been drilled down to 400 meters. We see these very similar sort of a bulk underground mining of around 3 to 4 grams a ton, which is what Martiniere's resource currently is. But it's still at an early stage, and we'll continue to first demonstrate the size potential and then later on update the mineral resource estimate at Martiniere, which I don't expect it to be in 2024. We expect Martiniere's updated mineral resource to be perhaps the year after. There are no other questions in here, Janelle. I've answered every question that's been here. Oh, sorry, I missed one. How long has Eric Sprott been an owner? Well, Eric Sprott, I believe, became a shareholder in 2018 and continued to add to his position. We all know Eric Sprott has invested in a lot of companies, and certainly his only exit strategy is by purchase by another company of his assets. So as a result, he's been very supportive of the company's efforts from what we know. And the reason I say that is because I don't believe he has sold one share of his holdings in WallBridge. So that's a sign of support. And Agnico Eagle, who's our 9.9% shareholder, has also always can come in our last financings to their pro rata. So basically, those are our two as well as William Day, who's never sold any shares as well. So we see three supportive shareholders, and we'll continue to